After releasing a couple of videos on tax-free income planning, I've been getting calls from people who are the working classes, especially people who are on W-2s and professionals. They were asking me if they have some way of resolving their tax situation than from paying higher taxes. Ever since the new tax law has been passed, that means with effect from 2018 onwards, we have started seeing a big disparity in the revenue that the government has been getting from taxable sources. The total income tax revenue that the United States received in the year 2018 tax period was amounting to $3.5 trillion. Thus, a spike in the income tax revenue for the IRS, especially in the year 2018, by an amount equivalent to $14 billion. This gives an idea that ever since they have taken off the itemized deduction and capped standard deduction to $24,000, the tendency among people, especially the tax preparers, CPAs and other people who are preparing taxes, were not able to give much benefit to the clients or the taxpayers in the United States. So from this understanding, what we have seen that IRS started auditing tax returns filed prior to 2018. So once they audit, what happens, they will audit for like at least 3 years from 2017 onwards, backwards. So if that happens, many people will be subjected to tax audit and they will have to pay taxes based on IRS estimation. This discrepancy in the revenue part of the IRS is going to create a lot of problems for people who haven't had a strategy to file and pay taxes. Today, I would like to just a little bit go on the tax-free income planning, which I have started mentioning about avoiding tax. It needs to go through a free evaluation. There is no charge that we do with the clients. Rather, we subject them to a free evaluation, which will help them to understand their situation, whether they will be able to cope up with the tax-free income plan. And this is equally applicable to the self-employed as well as the employed people. Means people who are on W-2, people who are getting 1099. So more people can definitely take benefit of this plan, which is going to have a sunset before 2026. Means it's going to be over by December 31st, 2025. So till then, this is in effect. So when we do the tax-free income planning, first of all, we are going to get a 30%, up to 30% deduction in the current tax liability. Second thing, what we can do, we can make the tax, the taxable income after retirement 100% free through our tax planning strategies. These things are pretty much available to everyone, whether they are not doing a business or they are on W-2. Regardless of these things, this is going to happen. When we take into account of this new tax reform, let us go through some of the major changes for 2019. First of all, the medical expense deduction last year was like 7.5% of the adjusted gross income. So, which was actively in effect, but earlier it was like 10% of the adjusted gross income. Now the government has placed it back unless until they make another enactment or any other laws pertaining to make it retroactive. Otherwise, what happens from this year onwards, a taxpayer can have the medical expenses deducted up to 10% from 2019 onwards. The second major attraction of the new tax reform is alimony. So alimony, that was tax deductible earlier, but now it is not more. It is not anymore. The third thing, that is possible is that no more Obamacare penalty. Previously, we were facing, every taxpayer was facing this problem that they had to pay penalty for not having insurance coverage. So when we look into the scenario of tax situation, let us go to the tax bracket. The tax bracket from 2019 and 2018, what we can see that they are the same tax bracket, like 10%, 12%, 22%, 24%, 32, 35 and 37. Compared to 18 and 2019, we can see that the income tax bracket still seems pretty much the same, but a little bit, difference in that. The first one we can see that when you take into consideration of a single taxpayer, his 10% tax bracket comes to up to $9,525 in 2018. Now it is going to be $9,700. So they pretty much increased. So the highest tax bracket is going to go with a single filer is 37% for those who have income greater than $500,000, and this year it is $510,301. So this is what it is. So let us go to married filing joint tax returns and qualifying widows. Here you can see that when it is a joint filing, the 10% bracket is below. In 2018, $19,050, but this year you can see that is when that went up a little higher, like now $19,400 for 10%. And 12% married filing joint in 2019, it is $19,401 to $78,000. 22% tax bracket is coming to $78,951 to like $168,400. So the highest bracket from tax bracket, which is 37% from the previous year, 600,000 is went up by another couple of $1,000, pretty much for 37% tax bracket people. So let us go to the next tax bracket. The head of the household tax bracket is 10%. Those who fall within 13,850, and the next level is 12%. That is 13,851 to $52,000. So the highest tax bracket with is 37% is for those people with income greater than $510,000. So the standard deduction, yes, the standard deduction for single filers in 2019 is now $12,200. Married filing joint, it is $24,400. The head of the household, it is pretty much $18,350. And additional standard deduction for people who have reached 65 and above is $1,300. $1,300 for each married filing taxpayers, and unmarried taxpayers is $1,650. The SALT deduction. SALT deduction means state and local tax. Starting with 2018 tax year, the maximum SALT deduction is $10,000. There's no change for the SALT tax deduction even in 2019. IRA contributions. The IRA contribution limit for Roth IRA and traditional IRA has increased to $6,000. The catch-up contribution for people over 50 and above, there is a little bit inflation adjustment, and therefore it is still $1,000. That means they can contribute up to $7,000. 401k, 403b, and 457b contribution limits. So 401k contribution, single filers, it's $19,000. Married filing jointly, it is going to be $25,000. The catch-up contribution is another $6,000 for 401k, and the maximum contribution for self-employed person, SEP IRAs, is going to be $56,000. HSA contribution. HSA is possible only with the high deductibles, with the high deductible plan through an employer. In that situation, unless you have $2,700 high deductible, you won't be able to contribute. But per person contribution is limited to $3,500. Per family, it can be $7,000. 529 college plan. 529 college plans in 2019 is pretty much the same based on the gift exclusion, like up to $15,000 you can contribute towards the 529 plan for a child for a period of like 5 years, means the maximum contribution should not increase more than $75,000. The aggregate limit of contribution based on the state limitations, it is $235,000 to $529,000 based on the nature of the program that student is attending. But this varies with the state. Different state has a different limit. The contribution deadline is before December 31st. Child tax credits is the same. There's no change in child tax credit for 2019. It is $2,000 for child below the age of 17, and out of this $2,000, $1,400 is a refundable credit, and that's how it is. Capital gain taxes. Capital gain tax, there's a little bit change in long-term capital gain tax. For 0% tax rate, it falls within people with the $78,000. For married filing joint, single filers, it is $52,000. If head of the household, it is $39,000. And the next tax bracket is 15% tax bracket. Those who have income limit between $78,000 to like $488,850, they pay 15% tax rate. But single, they pay like $461,000 for single filers. So that's no big change, but still you can see people who convert their income to capital gains may pay only 15% tax up to the extent of $488,000. AMT exemption amount is increased to $71,700 for single filers and head of the household as well. So, however, with married filing joint status, people pay $111,700. There it is going to face out. There's the big change in alternative minimum tax when we compare between this 2017-2018. You can see that married filing joint status household face out limit from 2017, that was 84,000. It went up to 109,000, and now it's $111,700. So the face out threshold for married filing joint status in 2017, $160,000. And that went up to in 2018 $1 million, and now it is $1,020,600. Estate tax stays the same, but there's a little spike. In 2018, estate tax was for individuals, it was 11.18 million, and in 2019 it went up to 11.4 million, and annual exclusion is 15,000. That stays the same. Pass-through entities with the QBI deduction, we call it 199 deductions for pass-through entities. That has also been through little changes. Now, from $315,000, the phase out, the reduction starts from now $321,400, and for that, this is for the married filing joint filers. For the individuals, it is $160,725. So that's where they are single filing status people. Within these circumstances, one can easily take advantage of some areas which I am going to refer to now. The most advantageous area is charitable deduction. When there is a public charity, you get 60% deduction. When there is a private foundation, it is 30%. Most of the people don't know that private foundation, you can have any family member within a foundation, and through the foundation, you're going to save almost 30% in your taxes, provided you donate money into a private foundation. Contribution to retirement account. So here is an example of how you can grow your money by contributing into a retirement account. Let's say a person contributing $5,000 for a 10-year plan, and the annual contribution goes $5,000. In a year, in another 10 years, that money is going to grow $78,000. If someone contributes $10,000, in another 10 years' time, it's going to grow by $156,000. If somebody contributes per year, that money goes to $15,000. So your contribution to retirement plan can go to that extent of like $19,000, and people above age 50 and above, they can contribute $25,000. So we can take advantage of all these things reduce your taxable income. So any amount you contribute will be reduced for your tax calculations. Yeah, the scenario, like a contribution of 5,000, for example, will shrink your taxable income by 5,000. And if you are in the 25% tax bracket, then you can save almost $12,000. You can contribute, it's a post-tax money, it doesn't matter much. But you contribute into other traditional IRAs, there you get a tax deduction, and that will eventually help you save almost $12,000. The other deduction, which is pretty much easy for self-employed people, and they can take advantage at this time, is home office deduction. So they can definitely make use of this provision, provided they have a business. So it is always advisable to have a business, for each and every person, if they are getting W-2 or they are unemployed. The next one, which we have already talked about, that health savings account, it is a good source of reducing your tax liability. The money you save it into health savings account that you can spend all the year, and that will further help you to reduce your taxable income. State and local taxes, yes, here is the deal. When the itemized deductions start kicking in, the state and local taxes is limited to $10,000, where many people cannot take deductions beyond this $10,000. So those people always should think about a tax planning through which they can have further deductions. Mortgage interest is another thing. Mortgage interest is tax deductible, especially for your primary home. No HELOC, no other boards or nothing. Only your primary loan, primary home acquisition indebtedness can be made tax deductible. The interest towards that is tax deductible. Yeah, in order to give you a better advice on this tax-free planning, so we provide you a free evaluation of your situation to reduce your tax liability. There's no commitment, no obligation. You can reach us anytime. If you have found this video informative and educative, please leave a like and subscribe. Thank you.